Okay, so we're ready for the last session of the conference. It's time flies when you're having fun, but you know, it's a very exciting session, and we're going to start with David Schwartz, who's one of the co-creator of CRP Ledger and Ripple, and who's going to talk about a slightly controversial title that the best incentives is no incentives. So give it up. Thank you.
Hi, I'm David Schwartz, as you just heard. I'm one of the co-creators of the XRP Ledger, currently CTO at Ripple. I want to thank Stanford and Dan Bonet for inviting me. It's great to be here. This is a talk I wanted to give about 7 years ago, but there would have been no place to give it and nobody to give it to. So I probably would have had to spend a lot more time explaining what the heck I'm talking about. It's nice that we sort of have a shared understanding now, that I can sort of explain the decisions that we made back in 2012 and 2013. I feel like I almost have to give a trigger warning here. If there are any Bitcoin maximalists who wandered into the room, some of this material may be a bit triggering for them. Just a heads up. So what is the problem? Why do we need incentives in blockchain systems? You might think that we sort of don't need them, that everybody can just run some software and everything will just work. And in particular, public blockchains have the characteristics that you see on the screen, that system state is public, and every honest participant in the system knows which transactions are valid. They know the rules for determining whether a transaction is valid or not, and they know the rules for determining what a transaction does. So you might think, well, geez, isn't that enough? Like if we're going to agree on which transactions are valid, and we're going to agree on what transactions do, what do we need incentives for? And it's important to keep in mind that we really don't care what sort of dishonest participants can do to themselves or each other. If I'm a dishonest participant in Bitcoin, I can modify my software to tell me that I have 1 trillion Bitcoin. It doesn't harm anybody. What we care about is what dishonest participants can do to honest participants, people who want to follow the rules and get the system's benefits. So why do public blockchains need incentives? It's the double spend problem. I think you probably most of you knew that. We can have more than one way to make forward progress. If Alice can send a Bitcoin to Bill, she can also send a Bitcoin to Charlie. If Bill's going to send her a cell phone or something, she needs to know that the transaction sending the Bitcoin to him will ultimately be accepted by all the other honest participants. We need eventual agreement for a system to be useful. And the problem is, if Alice can send her Bitcoin to Bill, she can also send her Bitcoin to Charlie. Both of those transactions are valid. So the core problem that we have is there can be more than one way to make valid forward progress. That's the reason we need incentives. And I just want to point out that an important characteristic, which is if there are objectively better ways to make forward progress, so for example, let's say we could make forward progress by executing no transactions at all, or we could make forward progress by executing a valid transaction. All honest participants, assuming this is in accord with the system rules, will agree that executing the transaction is better than not executing it. So we don't need incentives where one path forward is objectively better than another. Honest participants will just agree that the better one is better according to the system's rules. The problem we have is when there are two equally good ways to make forward progress. And it's important to understand that because they're equally good, honest participants don't care which way we make forward progress. If Alice wants to submit a transaction sending a Bitcoin to Bill and she wants to also submit a transaction sending that same Bitcoin to Charlie, she's being a jerk. We just want to not have disagreement. We don't care whether her Bitcoin goes to Bill or Charlie. Like she could have decided where her Bitcoin went by submitting only one transaction. But she was a jerk and submitted 2 conflicting transactions. She gets whatever happens. Like nobody can. We just need to agree on which of the equally good ways we make forward progress. So it's a very, very bounded problem that we need incentives for. When we have 2 equally good ways to make forward progress, how do the honest stakeholders eventually agree on one of them? That's the actual problem. That's all it is. Sounds pretty simple. So I use the word stakeholder, and I want to talk about what stakeholders are just so that I'm somewhat clear in my terminology. So stakeholders are people who get value from a system. Stakeholders have a problem that the system solves, and stakeholders want the system to function. So if the system is eBay, the stakeholders are people who want to buy things, people who want to sell things, and eBay. Like all 3 of those groups of people have a problem that eBay solves, assuming that it works for them, and they all want eBay to function reliably and smoothly, but of course their interests are not perfectly aligned, right? Like buyers and sellers probably want low transaction fees, eBay probably wants the highest transaction fees the market will tolerate. So stakeholders don't automatically have aligned incentives, but they do have partially aligned incentives because they all want the system to work. When I use the term natural stakeholder, what I mean are the stakeholders whose problem the system is designed to solve. That's a little imprecise because you could argue eBay is designed to solve the eBay stockholders' problems of making money. That's not what I mean. I don't mean the intermediaries who are sort of making money from solving what are fundamentally other people's problems. I mean the people who have a problem that the system solves other than how can we make some money or build a system that solves other people's problems to make money. So miners are not natural stakeholders in Bitcoin. Bitcoin was not built to solve a problem that miners had, that they couldn't turn electricity into money. You could imagine a system that was built for that purpose, but Bitcoin wasn't really built that way. Bitcoin was built to solve the problem of people who wanted a means of exchange or a store of value or whatever you think Bitcoin is. And those are the natural stakeholders. Those are the people who the system solves a pre-existing problem for. They're the ones who get benefit from the system and are willing to pay to have that system solve their problems. By a forced stakeholder, I mean the residual friction in the system, the people who you need to make the system work. If eBay could work without eBay, then the people buying and selling, we would think, would prefer that system, all other things being equal. This is the push for decentralization, is to eliminate the forced stakeholders. These are the people who extract value from the system, and they represent residual friction that the system has not removed. And I should point out that one of the core pitches of decentralized systems is that you get rid of the forced stakeholders. Why do I want to be my own bank? Why do I want eBay without eBay? Why do I want Uber without Uber? It's because the forced stakeholders impose rules that the natural stakeholders would prefer not to have to follow or would prefer not to have to pay for. So these are the sort of residual friction in the system that the natural stakeholders, the people whose problem the system solves, the people who are paying the fees, want low fees. The forced stakeholders want high fees because they profit from those fees. Of course, if the system's too expensive, the system won't solve any remaining problems, and so their incentives are somewhat aligned but not perfectly aligned. They all want the system to work, but forced stakeholders want to make more money, whereas natural stakeholders want the system to solve their problems cheaply. So eBay is a forced stakeholder in eBay. Miners are forced stakeholders in Bitcoin. If you're someone who wants to perform a transaction, you want low transaction fees. High transaction fees don't benefit you, except to the fact that they make the system work. And natural stakeholders prefer as little value go to forced stakeholders as possible. This is the tension in any one of those systems, right? Uber wants Uber to be expensive. It's more money to go around. People who use Uber want Uber to be cheap. People who drive for Uber don't want Uber to take a whole bunch of money, right? So the natural stakeholders always want the middlemen to go away. And I'll point out that, like, one of the big promises of public blockchain systems was this reduction of middlemen. What does a pitch like be your own bank mean? What does a pitch like, no one can tell you, no one's like sort of parasitically taking money from you? It's that those middlemen either don't exist or their role is very minimal. So operational decentralization is assurance of inherent fairness. If I'm selling something on eBay, I want everybody who wants to complete an honest transaction to be able to bid for it. If eBay doesn't do business in Thailand for some reason, I lose out on the money from people in Thailand. I don't sell my stuff for as much. Operational decentralization is a sort of short-term assurance of fairness. And it doesn't exclude long-term concerns. So for example, operational decentralization with Bitcoin means if I submit a Bitcoin transaction right now, and it complies with all of the rules, it pays a large enough fee, I have the Bitcoins, it's all valid, can I have reasonable assurance that it's going to execute, that the system isn't going to sort of single me out? It's a form of sort of short-term censorship. Now, it's independent of the question of, like, will Bitcoin be the same in 10 years as it is now? Or, right now there's only 21 million Bitcoins. Will the rules be the same a year from now, or might the rules change so that there's 22 million Bitcoins? That's not part of operational decentralization. Operational decentralization is that sort of short-term guarantee that your transactions will execute according to the system's rules without some sort of external bias or unfairness. The next step up is governance, which is sort of the longer-term timeframes. Governance is what stops the rules in Bitcoin from changing. Governance is what controls the changes of rules and systems, because sometimes they do need to change. Governance is how you stave off technological obsolescence, right? It took governance to change the block size for Bitcoin Cash. It took governance to add segregated witness. These avoid chaos when the system's rules need to be changed. And again, the natural stakeholders probably don't want a system to become technologically obsolete. And I feel the need to point out, this is a bit of an aside here, that what we mean is what the stakeholders can realistically expect. And the reason I have to point that out is some people will argue that, like, there'll only ever be 21 million Bitcoins in existence because if someone changed the rules so there'd be 22 million Bitcoins, it wouldn't be Bitcoin anymore. Well, that doesn't matter if I'm a natural stakeholder. If I'm a natural stakeholder who holds Bitcoin and Bitcoin stops working and the miners are like, look, there needs to be a block reward or the system's not going to work, they agree to raise the block reward back from 0 and there are more Bitcoins and the system that I used to have is just defunct and the Bitcoins that I'm holding are now on a system that has more than 21 million, regardless of what definitional game you play, from my point of view as a natural stakeholder, if I was relying on there never to be more than 21 million Bitcoin, that requirement has been violated. Now, presumably, if the alternative was that the system fails and stops working, I'm happy with that change. If I'm a stakeholder who wants the system to continue to work, I would not be happy with a system where there are only 21 million Bitcoins but isn't useful. So it's not necessarily bad if the system sort of violates our assumptions, but it's important to understand that what we care about is like, what is a stakeholder actually going to get out of the system as opposed to sort of what definitional tricks we can play. So the first solution to this problem was proof of work, circa 2009. Proof of work is expensive. The biggest problem with proof of work is that honest participants have to actually pay as much as any attacker is willing to pay. If you think about that, that's like the worst possible security model from a cost efficiency standpoint. Again, the natural stakeholders, the people who are paying the miners to mine, the people who are buying the Bitcoins that the miners make, the people whose money is coming from outside the Bitcoin ecosystem and going to build ASICs and going to pay for electricity, have to actually pay on a continuous basis more money than any attacker is willing to pay to execute a double spend. I mean, imagine if I don't want people to steal my TV that's worth $300 and I have to constantly pay $300 to do that because an attacker is willing to spend up to $300 to take my TV. Why do I have a TV again? Like, I didn't gain any benefit from having the TV because I'm having to constantly pay its value just to hold still. And Bitcoin costs millions of dollars a day just to maintain sort of the ability for it to move transactions. And that's money that comes from the natural stakeholders and goes to the artificial stakeholders. That's really functionally no different from eBay fees. That's no different from what any middleman injects into a system. Not necessarily a bad thing. You could also argue that the miners are stakeholders, like they want to turn electricity into money. But if you're just a person who doesn't care about turning electricity into money, from your point of view, that's friction. And it's a misalignment of incentives, because miners want high fees and they have a stake in the system, and people who are transacting want low fees. It also creates the risk of a double spend attack. If the token doesn't have value, proof of work doesn't work anyway, right? Like, how do you pay for electricity if you're not mining a token that has value? If the token has value, then there's a financial incentive to execute a double spend attack. And it's not really clear how you recover from a double spend attack. If you don't change anything, you're just as vulnerable to a double spend attack afterwards as you were before. If the value of the token drops, arguably you're more vulnerable to a double spend attack. You could change the mining algorithm and make people's ASICs worthless, but if you didn't have enough honest miners before and you just screwed over all the honest miners because you turned their ASICs into space heaters, wait, let me rephrase that. You turned their ASICs into expensive space heaters a little faster than they would have otherwise, good luck encouraging new mining. Weirdly, irrational markets don't seem to care that much. We saw some double spend attacks on some blockchains that were proof of work based with very little proof of work, and their prices didn't crash, so maybe we don't care. But if you're a stakeholder who wants to get value out of a system, you should care, because that destroys your ability to use the system. It destroys your ability to rely on it. Again, though, these systems work in practice. They work in practice. Bitcoin works fine. Like, from what I just said, you might think, well, Bitcoin's terrible. It doesn't work. It's awful. It has all these problems. It works just fine. So it kind of proves that, like, you can have a lot of characteristics that are objectively bad, and the system still works just fine. That's kind of proof that Bitcoin satisfies a very real and very profound need, that it can have, like, all of these technical criticisms that I can make about it that make it way too expensive and so on, and yet people still find it useful, or at least they believe that people will find it useful in the future, at least. So that's still something. Proof of work can do the initial distribution of a currency. That's always going to have to require something expensive, right? If I'm going to give away my phone to someone, and you know, everyone's going to want the phone. Like, there has to be something expensive to stop people from getting it. Otherwise, everybody's going to want it. Everyone's going to take it. So proof of work can do the initial distribution of a currency. It's hard to imagine how you could do that with some other scheme that didn't have this kind of high cost. Miners are forced stakeholders. Natural stakeholders have to act through miners. Miners want high fees. They're not the producers of the system's value. They're the people who sort of take value out of the system and use it to buy electricity and use it to buy ASICs and use it to make a profit. They make a profit from solving other people's problems. They're classic intermediaries. But again, not necessarily a bad thing. Works fine. You know, like, if that sounds awful, well, Bitcoin's still doing great. It's still the granddaddy of them all. It's still, the value is held. It's solving real world problems, or at least seems to be. Or at least people expect it will in the future. So, you know, what can I tell you? Proof of work relies on native value, though. You can't use proof of work on a system that doesn't have some sort of native value. You got to pay real money to the miners, otherwise they're not going to be able to afford proof of work, and the system's security is tied to the value of this token. This is why proof of work is terrible to use in a system like, for example, Ethereum, because Ethereum hosts ERC20 tokens that are not Ether. But if the system's like value and security and proof of work ecosystem is fundamentally tied to its native token, it's hard to imagine how you can meet the security requirements of non-native tokens. Just to give like an example of how this would fail, suppose there's an ERC20 token on Ethereum that's pegged to the dollar, and there's billions of it moving around, but the price of Ether drops to a very small amount of money. How does proof of work keep the system secured? You just keep giving more and more and more and more Ether as the value of Ether collapses down to zero. How do you secure the movement of the ERC20 token? And it's not clear that the system can capture the value of the other systems that ride on it. It may be that moving millions of dollars in value has a near zero cost. Like moving gigabytes of information has a near zero cost, right? Like the cost of moving things has come down to zero. So it could be very useful in the values it moved and capture very little value itself, and proof of work doesn't work if that happens. So it's not a good choice to build on. And it forces a race to the bottom. As we saw in the attacks on Ethereum last week, a miner has a free option. A miner can try to gain all of Ethereum's decentralized ecosystem at zero cost. He can assemble the transactions in a block however he wants. And if a miner makes more money by gaming the DeFi ecosystem, by taking orders that have gotten out of balance, not allowing people to cancel orders, whatever he does, he's going to make more money than miners that don't do that, and so he's going to mine more and they're going to mine less, and he can force them out of business. Mining is a race to the bottom. You got to make the most money for every hash you do, or you're squeezed out of business. You got to do your hashes at the lowest cost possible. There is no incentive really to improve the network other than the sort of diffuse incentive that if the whole ecosystem is good, the system is better. But that's like what we don't rely on, right? Like if the only thing we relied on was that, well, miners want the system to work well, so they have this sort of diffuse incentive to make the system better. That's not how mining works, right? We presume miners are selfish. And so it forces a race to the bottom. I don't want you to mine because you're pushing the difficulty up for me, even if you're making the network better than I am. You're sort of indifferent to the quality of the network because you're forced to. And it doesn't really operationally decentralize very well. All of the people who mine look like all of the other people who mine. They're people who have cheap power and good hardware, can operate cheaply. They tend to be similar looking. Miners choose how the system makes forward progress. The only reason they have to provide operational decentralization is because if the system sucks, people won't use it. But that's true of eBay. I wouldn't say eBay is like operationally decentralized, but if eBay doesn't provide me a good service, nobody will use it and they'll go out of business. If that's the only incentive, boy, what did we build a public blockchain for? So this is something that I have to add to my talk. If I give this talk 7 years ago, there wouldn't be this section on staking and slashing because it didn't exist back then. But staking, you lock up a volatile asset and you take a risk of losing that asset if you mess up. And the fact is returns are going to have to be pretty high to justify that, right? Like if you had to lock up a bunch of Bitcoin or a bunch of Ethereum or a bunch of XRP for even a couple of days, these assets are very volatile. They're likely to stay volatile in the future. So you're going to have to get paid a good amount of money to take that risk. And you take the risk of losing the asset if you screw up. That's the point of staking, is that you can get slashed if you break system rules. So there's risk. The returns will have to be significant to justify the risk. And it has the same problem. The security is tied to the value of the native asset, so it's not useful for systems that don't have non-native assets that capture most of their value. It's also perfectly competitive, just like mining is. It's the same race to the bottom. It's also tax inefficient in many jurisdictions. Your staking rewards are taxable income, so everybody's staking, everybody's getting more tokens, everybody's paying taxes on them just to stay put. And again, you have a forced stakeholder. The stakers are forced stakeholders, solving the natural stakeholders' problems. Like, if the pitch is be your own bank, if the pitch is no intermediaries, if the pitch is eBay without eBay, there shouldn't be forced stakeholders. So what are the problems with incentives? They tax the natural stakeholders. There is friction resistant in the system. In some schemes, stakeholders are actually paying more than attackers are willing to pay. It's not quite as bad as staking, but it's still pretty bad. And it creates misalignment. The artificial stakeholders want high fees. They want to keep as much friction in the system as they can and still have it be attractive to the natural stakeholders. Natural stakeholders, the pitch is that there wouldn't be intermediaries. I guess we'll settle for low fees, but that's not the promise, right? So what's the alternative? What's the alternative is to exploit natural alignment. What that means is natural stakeholders are already aligned. They have an existing problem the system can solve. They all want it to be solved. They all want it cheap. They all want operational decentralization. All the natural stakeholders are aligned on just wanting to reach agreement on equally good ways to make forward progress. None of them care how the system makes forward progress among two equally good ways. They just want forward progress. They're all aligned. Why can't they solve that problem for themselves? And the answer is when you bring in incentives, you break it. If there are no incentives, then there can be low fees. And natural stakeholders want low fees. The only reason you need a high incentive is because mining is expensive. Yeah? How much time do I have? 5 minutes? The only reason you need high fees is because mining is expensive. It's a self-referential circle. Natural stakeholders want that cycle broken. A cheap system can exploit natural incentives. When I and others designed the XRP ledger in 2013, we focused on exploiting natural incentives. You do need something scarce. You have the possibility of a Sybil attack where someone just sort of prevents the stakeholders. Like you have two equally good ways to make forward progress, and a bunch of jerks are just like, I like this one, I like this one, I like this one, and you never reach agreement. The only thing you need is something scarce to protect against the Sybil attack. The XRP ledger uses stakeholder-chosen scarcity, which means if you're a natural stakeholder, you just choose anything scarce. It minimizes operational power. There's no unconfirmations and no dictator of the moment. It subjects operational power to objective rules. So there's rules to decide which transactions get included in which block. There's rules that say we don't consider invalid transactions. Valid transactions received must be included. And the only way to reject a valid transaction is to agree to include it in the very next round. Rounds are only about every 5 seconds. We let stakeholders exclude bad actors. If you see a Sybil attack, just stop listening to the nodes that are part of the Sybil attack. So good stakeholders stay in, bad stakeholders or fake stakeholders get ejected. There's no advantage to having bad actors in the system, right? If you have someone in Ethereum who's mining and gaming the decentralized exchange, we'd want to stop them from mining if we could, but we can't. And good actors accumulate. If you're making the network better, you want the network to be good, you keep operating, you bring the cost down, you have no artificial incentives. There's no incentive to attack the system. You can't double spend. You can't choose which transactions are included. You can only choose among two equally good ways of making forward progress, how you make forward progress, which nobody cares about anyway. So why would you even bother attacking the system? You get to attack it once, the system doesn't make forward progress, and then nobody listens to you anymore. So there's no incentive to attack the system. Stakeholders get what they want, minimal risk, drama, cost. So natural incentives are better than artificial incentives. Artificial incentives do all the bad things I mentioned. Natural incentives do all the good things. They decentralize because natural stakeholders are already aligned in wanting the system to be efficient. Gets you low fees, fast confirmations, and real censorship resistance. We built a ledger with a decentralized exchange, sophisticated payments with pathfinding, managed multi-signing and off-ledger scaling. Come to xrpl.org and see what we built, and Ripple's always hiring. And I'm probably way over time already, so I don't know if we have time left for questions. Oh, perfect. So I rushed for little reason.
Okay, just please walk up to the mic if you have any questions.
Thanks for the talk. So do you mean if we remove the block reward from POW and staking rewards from POS, then the blockchain will be way greater?
Yes. Yes. So what will happen is if you don't get paid for mining or you don't get paid for staking, there's no financial reward to it. The only reason to do it is if you want the system to be robust, reliable, and decentralized. There's no other reason. If it's low cost, if you don't have to provide expensive hashing, if all you're doing is saying, hey, there's two equally good ways we can make forward progress, I vote for the left one. That's all you're doing. That's literally all you're doing. You're saying, when there's two equally good ways to make forward progress, you arbitrarily pick one and you vote for it. If that's all you're doing, there's almost no cost. And if your only reason to do it is because you want the network to be more reliable and decentralized, yeah, the network's going to be more reliable and decentralized. Why would anything else happen? There's no incentive to attack the system. All you do when you attack the system is you cause it not to make forward progress, and then people stop listening to you. Yes, that's exactly what I'm saying.
Wow, that's a very crazy statement.
I agree. And I was going to poll the audience and ask how many people think I'm crazy with a show of hands before the talk and how many people think I'm crazy afterwards with a show of hands. And I know the number would go up, but yes, that is exactly what I'm saying. And yes, it's good that you think it's crazy. That means you understood what I was saying.
Yeah, because I think if you are not crazy, then most of blockchain's founders are crazy. Because they all come with incentives, right?
You know what? You know why? It's because they want to be the forced stakeholders. They want to make money by solving other people's problems. That's why. If you want to make money by solving other people's problems, the last thing you actually want to do is let people solve their own problems at low cost. I can't tell you how many great ideas I saw, and like, oh, and we added a token to it this way. Here's our tokenomics. Like, God, it was a great idea, and you just screwed it up. Solve people's problems. That's how you make money. You don't build friction into the system, you build friction out of the system. So yes, I agree with you that that's what a lot of people are doing, and I think they're doing it because they're attracted by like the quick route to riches by solving other people's problems. But if the pitch is stakeholders can solve their own problems, you can be your own bank, you don't eBay without eBay, then there isn't going to be these parties that are making money like out of reducing the friction in the system. There just isn't. Sorry, if you're here trying to make money, I can't help you.
My brain is washed.
I thought these jobs at Ripple don't pay money. I thought you just had offered some jobs.
So that's actually a great question. So there's two very different things that we're doing at Ripple. We certainly do lots of things that make money, but the other thing that we're trying to do, and this talk is kind of more in that spirit, is grow the blockchain space so that it solves people's real problems. The analogy that I would give is like, imagine if you worked at Twitter in the marketing department. Now I've got this phone here. I can tweet anytime I want, anywhere I want, pretty much. That's great for Twitter. Twitter did nothing to put this phone in my pocket, right? This phone is in my pocket because of competitors to Twitter from the past and because of like an entire ecosystem that creates Twitter's market. And the vast majority of what like the spring part of Ripple does is we're trying to sort of build a thriving blockchain ecosystem. And because that's what we think is going to create a target market for us to sell products and services into. And so that doesn't require us to make money from that. Like Google helped to build the internet because it made them money indirectly, but they didn't have to make money directly. They didn't have to monetize TCP/IP. They didn't have to monetize HTTP2, right? They want a robust and vibrant internet because that's their target market. So we also have the luxury of trying to like grow our target market.
So astute observations. Thank you for sharing all that. I wanted to piggyback on kind of what you said at the end there of Ripple has been around a lot longer than a lot of these other protocols, save Bitcoin. What do you attribute kind of like the asymmetry in terms of interest, developer adoption? Like, why are people so much interested in other things and not so much in Ripple?
It's kind of hard. It's kind of hard to say. I could come up with a lot of different theories. First of all, the original Ripple Pay system from 2003, Ryan Fugger's work, was way ahead of its time, and it was missing some of the decentralization that Bitcoin was able to bring to the table. Obviously, when Bitcoin came to the market, it promised operational decentralization, and it's done a very good job of delivering. Governance has been a little rocky, but it works very well. When you choose your currency, you don't necessarily, it's like choosing a sports team. Like when you choose a sport, my favorite sports teams are all the sports teams closest to me, right? Like I'm a Warriors fan, a lot of people probably know that. I'm a 49ers fan. It's not because I evaluated every sports team and I decided that the Warriors and the 49ers are most worthy of my support, right? It's they're closest to me, and so they have a sort of special place for me. And I think like when you choose a currency, why do most of us use dollars? Is it because we've evaluated every world currency and dollar is the best one? It's kind of like first to market. Bitcoin is good enough. And I think there's a challenge of solving real-world problems. Is Bitcoin solving real-world problems for people today, or is it the promise that it will solve real-world problems tomorrow? So I think another thing also is that it becomes very tied up with an ideology. There was kind of an anti-government, sort of be your own bank, kind of anti-banker, kind of quasi-libertarian ideology. And then it kind of got mixed up in this sort of like, if I believe Bitcoin is the future and I hold a lot of Bitcoin and you say Bitcoin's bad, like you're taking food out of my children's mouths, and I perceive you as sort of threatening my ideology. I think it's been a fairly toxic ecosystem, and I think we kind of should all work to sort of we're all in this together. If the crypto markets are sending us any signal, it's that we're all in this together. The market does not know if cryptocurrency is going to be a thing. And I think we need to work together to make sure that it is a thing. And then we can fight over, like, is it Bitcoin? Is it Ethereum? Is it XRP? Is it Litecoin? Is it some new thing that doesn't even exist today? Is it DeFi ecosystems that don't even have native tokens? Like, where is that value? If you worked at Google in the 90s, you would be excited about search. You would tell anybody who would listen about search. And you'd have been absolutely right. But you could also have been working at Excite, AltaVista, Ask Jeeves, Lycos, right? You would still have been right about search, right? Like, we don't know. We're nowhere near ready to figure out who the winners are going to be. But obviously, people have to decide where to place their bets if they're kind of in it for short-term profit.
Thanks.
Okay, do we have more questions?
Sorry, you just mentioned like Twitter as one of the analogy. Twitter actually from time to time bans some of the bad actors that they don't like, right? So in XRP, I've heard there's also such kind of capability, right? So do you imagine like XRP could be a platform for DeFi?
Well, so remember, we're talking about bad actors in the process of determining which of two equally good ways to make forward progress, which no honest participant cares about. We're not talking about censoring transactions. If you want to censor a transaction, by the rules of the XRP ledger, your ledger is objectively worse. It doesn't include a valid transaction. For you to say, I don't want to include this transaction, you have to acknowledge that you saw it, right? So imagine we're agreeing on which transactions are valid, and I say, we should include this transaction, and you say no. You can't say no a second time because you saw the transaction. Like in round 8, you can't say no in round 8 if you said no in round 7. If you said no in round 7, you definitely saw the transaction before round 8 began. You have no rationale for rejecting it. We're just talking about objectively equally good ways to make forward progress. You can be excluded from the process of making forward progress, but it's just like if you couldn't mine in Bitcoin. Imagine if Bitcoin miners didn't get paid any money and had to include all valid transactions in fee order. Would you care whether you were mining or not? You don't get paid any money and you have to follow objective rules. Why would you care? Your transactions will execute just the same, right? So yes, you can be excluded from the process of deciding which of two equally valid ways to make forward progress, but as a user of the system, you don't care. You just make sure you only submit one, you don't be a jerk like Alice and submit a transaction sending a currency to Bill and the same currency to Carol. You just submit one transaction, and then you don't care which way. It's clearly better to include a valid transaction than not to. So you don't care about the case in which you're excluded.
Okay.
Okay.
I think we're over time now. Let's give another round of applause.
Thank you.